the market, the sell-off has exacerbated. We have slipped below that 22,600 mark as well, very close to the support level that Sudeep mentioned. In fact, we are at 22,586 as we speak, and he had mentioned a floor of 22,580. Beyond that, of course, 22,550, 22,500. Those are the levels to watch out for. But yes, not a pretty picture when it comes to the screen. But on that note, let me bring on board our next guest for today. Joining me, Sunil Subramaniam, market expert. Sunil, hi. Lovely catching up again.
Hi,
Good
good morning.
morning for sports lovers, but not such a great morning when it comes to the market. We are staring at a 200-point loss on
Yes.
the Nifty. The advanced decline ratio extremely weak, dismal, 1:6 NSE advanced decline ratio. Mid caps, whatever little recovery we've seen, completely fizzled out. How does one navigate? Because every day you wake up, you hope to God that today maybe a day of recovery, and those couple of days did come last week, but we've again reversed course. Your thoughts as to how much longer will this pain last from here?
So I think that, it's a very complicated scenario, and I'll explain why. It's that domestic institutions are actually sitting on a lot of cash. Okay. If you see the total mutual fund industry, I was looking at it, there's about 3.5 lakh crores of cash in the mutual fund industry. Of course, you got to take out the debt and liquid funds. But even I would say in the equities and hybrid side, you're sitting on over 2 lakh crores of cash. Now, what's happening is that obviously India as a market, because of the two consecutive earnings seasons not being great, is now being clearly seen as an overvalued market. And the correction that's happened, unfortunately, hasn't brought it down to yet a reasonable valuation. And the reason for that is domestic buying. See, when the FIs sold the large caps, they went and actually bought. So that's why you see the correction in the large caps is far less than the correction in the mid and small cap. So what's happening is that from a foreigner's perspective, India still remains a reasonably overvalued market. And so whatever little money is coming out of this whole Trump uncertainty into the emerging market is going into markets like China, where they already were very beaten down. And so the margin of safety is higher. That even if the Trump tariffs come in, they expect China to do some counters, so the market is trading at such a low that the downside risk is less. Whereas in India, you still have to wait. Maybe by this month end, you'll get the GDP number for the previous quarter, and that will show whether from the 5.4 we made a jump up or not. Because sequentially the earnings were better, but the market has yet to adjust itself to those earnings. They still expected higher earnings from this quarter, and they were disappointing. So I would say that this is a very interesting because there is cash sitting on the sidelines. And there's an Alfred Tennyson poem, right? There's water, water everywhere, not a drop to drink. With such, SIP book is 26,000 crores for the mutual fund industry. The last month itself, around 40,000 crores of excess money, extra money came into the industry. But what's happening with the domestic fund managers? And today I believe that this uncertainty till Mr. Trump's actions of how far he uses tariff as a threat versus an actual tariff implementation, what is the reciprocal tariff from 1st April, we'll get to know. So the uncertainty is likely to prevail, and FIs are unlikely to make a strong move back into India because those markets haven't corrected enough in the large cap space. Domestic fund managers, on the other hand, are picking selective large caps. So if you see now, FIs have been selling banks and financial institutions, but domestics have been buying. That's why in the 6-month fall, private sector banks, for example, have fallen the least. So fund managers are very selectively buying some companies where they see no tariff threats and they see that the earnings season has been fairly decent and the outlook is fairly decent, which is true for the BFSI space. But in all of those spaces, domestic fund managers are also now hesitant to put because, like I said, they were disappointed with the earnings season. And until a fresh direction comes, either on a stock specific level where the numbers on the ground level sales numbers show themselves up for the running quarter well, and they'll be reinforced by this quarter's earnings season starting April, there's unlikely to be a very strong trigger. So domestic managers are doing extremely selective stock picking. In fact, they are booking profits on certain mid cap and small cap where they feel that they've made a huge amount of money because of the rise and the future outlook is not yet known. So I think the budget also in that sense, because where they had stocked up, if you see the prices which ran up was the public sector piece, the infra piece, and that's where they are actually selling now. So I'm saying that that's why I said it's a complicated thing because domestic fund managers who can actually protect the market and take it higher are not doing it because the future is not yet clear. So I think one must be prepared for a reasonably extended period of volatility and uncertainty in the markets. I think the broader markets will continue to suffer a little more pain. But I would like to end on a positive note to say that I think we are nearer to the end now and we are closer to reaching a bottom. So I expect some amount of a recovery to start in the next few weeks and then gather momentum in the month of April.
Okay, positive note indeed. Bottom may in fact be in sight, maybe a couple of weeks when we could see some bit of a recovery. But you mentioned that private banks have seen the least or lesser correction. What are your thoughts on PSU banks? Today I was reading a note by Incred. They have in fact downgraded SBI and they are saying that return on asset may moderate as margins decline and credit costs normalize. In light of that, your thoughts on the entire PSU basket. Also, RBI has announced a $10 billion dollar rupee buy sell swap to inject longer duration liquidity. This comes after the last round of 5 billion, right? So, do you think this will effectively address the system liquidity issue?
So two things. Let me answer the first question first. So overall on the overall PSE pack, and then I'll come to the PS banks pack. PSE pack I still feel is overvalued, despite the fact that there's been so much correction in the PSE index. Considering that they're all railway, defense, a lot of those kind of stocks, I think there's still more pain there. So I would overall say that the PSE space is not yet an investable space from a valuation perspective. Coming to public sector banks, so I think that yes, I think to the extent that they are largely been non-retail players, historically. There have been people who have depended on CASA and have financed the corporate lending book. And as you know, over the last few years, corporate lending hasn't really picked up. And they have been entering the retail space. And I think the first steps there, the challenges at the very low end of the retail lending, right, are clearly now visible. What is seen in the small finance banks and the microfinance space and all of that is slowly creeping into this because these people didn't have a vast deal of experience in dealing with retail lending. That was a space where the private sector banks, the private sector NBFCs were the leaders there. So I think their models are very well established in the NBFC and the private bank space. The PSU banks, I think, are still trying to figure out what is the right way to assess risk in a large population when you lend with very less security and with not much control over the end use of funds. So I think those pain factors are being seen. But that being said, I think that the whole giveaway in the budget of the 100,000 crores, a portion of which moves to savings, I think will come into the CASA of the public sector banks. So I think that's one green light in the public sector banks. Second, I think this consumption is definitely going to be the space which is going to benefit from that giveaway. And as mass consumption goes up over the rest of the year, I would expect corporate lending to pick up because private capex, I say, is probably a 9-12 month away from picking up. And that's when the public sector banks will take a lead. So to me, if you're a medium-term investor in this space, then I would say every correction, you keep buying a little bit of public sector banks because ultimately when corporate lending picks up, right, they are going to be at the leaders because that's the business they understand, they know very well, especially in the MSME space and where the NIMs are also very, very good because there's no pricing pressure is very less. So I would say that in the short run, if you have a 3, 6, 9 month view, public sector banks are probably going to see a little bit of a iffy run, but taking these corrections as a good pricier points to buy, I would say from a year and a half, 2 year perspective, you would probably be making a good deal of money if you keep accumulating them. So expect short-term volatility, but in the medium term, public sector banks should help out. So the next question that you had was the injection of liquidity by RBI. Now, I don't now say while there's a liquidity deficit and they're addressing it, remember that the liquidity deficit is caused by the RBI because of their action to support the rupee. So they are only redressing a gap they are creating. This liquidity gap has not come because of a domestic huge demand and no supply of money. It's been created by RBI and being set right by RBI. So it's just bringing it back to an even Steven. So while the injection is needed, it's preventing a short liquidity from hurting the system, but it's not something that the domestic liquidity shortage was created by credit deposit ratios going out of whack. And hence RBI is stepping in. So there are two clear reasons. RBI is just setting right what I wouldn't call it damage, but the impact of defending the rupee is being felt and they are just setting it right. So they're just bringing it back to even keel.
Got your point. Another thing that the RBI has proposed is to eliminate loan foreclosure charges and prepayment penalties when it comes to NBFCs. How do you see this impacting the profitability and lending strategies for NBFCs? Could we expect a shift in pricing models such as higher processing fees to mitigate the impact on margins?
Yes, I think they will have to do that. I'll tell you why. Because essentially, the reason why a prepayment is charged is because there's an asset liability mismatch. Suppose you're borrowed long to lend long, and somebody is closing the loan, you have to unwind that long borrowing. And there will be a cost for unwinding the borrowing because based on how interest rates are moved, they will be having to take off that asset. So, from the fact that an asset liability management of the NBFC private sector bank had factored in a certain amount, and they were hoping that somebody pre-closes, the cost of their pre-closing their own long-term liability was going to be offset by a pre-closure charges. That if RBI implements this, then that goes away. So the three things. One, obviously, they will try to increase processing fees to make good the loss. Second is they will have to readjust the way they finance the book. So if let's say there's a 15-year loan, right, and then weighted average maturity of a 15-year home loan, let's say, is 7.5 years, just out of the blue, right? So at 7.5 years, they would have had a 7.5-year duration of their borrowing book. But now, factoring the fact that people will tend to prepay, they will have to shorten that period and make it 5 years. So they will run that risk. Those who manage it well can still get out. But it will change the way NBFCs and banks fund the loans. That is the longer term impact of this, which I think ultimately they are smart enough to manage and to do. But there will be a period of pain when they will not be able to receive any prepayment charges, but they will be still holding longer than needed liabilities on their books. So that's an adjustment period which we'll have to go through.
All right, that's well explained, really, Sunil. Last couple of questions then. I want to talk about the auto pack, particularly M&M. Of course, this stock has seen a sizable correction. Today, of course, there's some bit of a green when it comes to M&M. But of course, there are concerns over Tesla's potential entry into India, and with the new EV policy, which in fact may reduce import duty significantly. Do you think the valuations, at least for M&M and some of these Indian OEMs, now capture the risks? And do you think Indian OEMs will actually see a significant impact of Tesla's India entry in the first place?
See, I think that there will be some impact, and the reason is that if you see in the auto space, the K-shaped recovery has been very clear, right? It's the high-end automobiles that are selling, not the low-end automobiles. And Tesla, if they come in, is going to be at the high end. Now, depending on the level of pricing that Tesla brings into the market, at the high end, obviously there will be challenges. And I think M&M and companies like M&M, like Tata's and others, who are making a big pitch into the EV space, might have to look at how they price their product. So there could be margin pressures more in anticipation, right? Now, the point is like this, in import duties are reduced even for the components, right? Part of it could benefit them because I think all these EV companies are still importing significant amount of the value chain from abroad. So there could be a benefit to them too. So overall, while I think it's good for the industry, individual players, I think, will definitely have to prepare their game plans. And unless there is clarity around this, the uncertainty will hit and the risk premium required of those stocks will naturally go up. So I think that's the pain you're seeing because it's still a gray area in what exactly form is Tesla going to come, how far they're going to indigenize their manufacture versus import from overseas and all of those pieces. So I think it's a wait and watch scenario, but definitely you can't say it's without impact because Tesla is a big player and it's an aspirational buy. So a lot of the high-end customers, right, would like to probably try it out. So you can't deny that.
Sure, taking your point then. Last question really, what are your thoughts on the QSR pack now within the consumption basket? The stocks have seen some good moves recent times. Of course, our outlook may be improving with tax cuts and easing food inflation as well, but numbers wise as well, on a sequential basis, Jubilant Food handed in a good quarter early report card. So would you, within the consumption basket, would you look at QSR now? Are the valuations looking attractive? Because they did see quite a bit of a correction, in recent times.
No, yes, I think QSR is the way to go. I think that those valuations, I think, yes, they're still a little bit rich, but I would say they're still a good bets to take because they are not in this whole tariff space, so that uncertainty will not prevail on them. The second aspect there is that they're not in the lending space where you're seeing some NPAs come and hurt. So they are out of that risk space, right? And essentially they are taking on the mass of the brick and mortar typical consumer pack. So from that point of view, I think that the growing younger demography of India, the access to the internet and all of those of which are India's success stories, clearly plays out in the QSR space. And I think increasingly that's a space where you should probably not pick one or two players to bet on, but diversify across the whole QSR pack. Because it's hard to pick winners, because it's again a dog eat dog world. People will be going hammer and tongs at offering various freebies and this to gain share. You have the existing people also adding QSR to there. The existing consumer giants will add there. So it's a fastest growing space, I would say, in the country. And it's definitely good from my investment perspective to stay invested. But I would still say don't try to pick a winner. Try to diversify across the basket.
Okay, and one last question then really, if one wants to utilize the market correction to, look at themes that are a good, 3 to 5 year kind of a theme for wealth creation, or even 5 to 10 years for that matter, should one use this correction to get into those sectors, and would you be able to identify 2 or 3 such sectors?
So to me, I think the 3 sectors which from a 3 to 5 year perspective will do well are the BFSI space. And when I say BFSI, we did discuss PSU banks, we discussed private sector banks, but I'm not talking about the lending side alone. I'm talking about the savings and investment bank. So I think when you say BFSI, you're handling both sides of the balance sheet. They're less subject to tariff pressures. And I think as a growing economy, see, you say slow down, whatever it is, we are still at 6.5%, the fastest growing country by a couple of 100 basis points in the world. So I think we should not take our grounds for growth is there. And that will reflect in increasing jobs, increasing per capita income, and increasing savings and investments, as well as borrowing. So for me, the BFSI pack, despite the volatility we discussed on the PSBs, on everything else in the near term, is still a good accumulate on corrections pack over the next year with a 3 to 5 year outlook. That's my number one pick. The second would be consumer discretionary, because I see that, I think the monsoon is expected to be good this year. The early signs are positive. Rural demand should continue to pick up, and with the giveaways in the budget, I think urban demand should catch up. And I think discretionary consumption is where they will see the impact, because those are EMI driven consumptions where you can make that extra rupee go that much farther. So I believe that discretionary consumption is a good play again from a 3 to 5 year perspective. And with these two, right, for me, capital goods and infra as a space, building materials, capital goods, infra, EPC is now turning good, because it was excessively valued a few months ago. And I see a lot of pain happening in that sector, and that may continue for some time, but it's a good time to start gradually accumulating capital goods and infra, because ultimately this discretionary consumption piece is going to lead to capacity utilization going up in the country and private sector capital entering. It's hard to say when, but it's definitely going to happen over the medium term. So you can start buying slowly and gradually. I would say setting up a SIP or a STP into these 3 sectors over the next 12 months will give you very good value in a 3 to 5 year time frame. So to repeat again, BFSI, overall pack, consumer discretionary, and the overall capital goods space, do a gradual accumulation over the next year.
All right, got your point. In those 3 sectors, keep them on your radar. That's the advice coming in from Sunil. With that, Sunil, always appreciate chatting with you. It's very insightful, and your explanations are really simple, and they really help our viewers in understanding the current scenario. Thanks a lot, and I wish to communicate with you again on one of the shows in the coming days.
Sure. Thank you, and all the best.
Thank you. Well, with that, of course, looking at the market, 22,000